You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We're a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me. First, there are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan or a plan to save you money, I personally work with you, even if you don't have any needs today. Save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, of course, we are celebrating the day we celebrate every day on Ron Siegel Radio. National Hard Candy Day. Shouldn't that be like a Halloween thing? Maybe a candy cane? I could see if we went with that one, but okay. And National Oatmeal Muffin Day. Oatmeal muffin with whipped cream. Yeah, there we go. I noticed that. Okay. Gotta love it. Maybe a little butter on that one too might be good. So we'll, it's does the oatmeal muffin, was it Mimi's has that raisin bran muffin? Does that count? Oh, that's like a little cake. I guess you're right, Josh. I can't count that. It won't work. Let's take a look and see what's going on in the markets today. The Dow Jones Industrial Average is down 50 points. The S&P down 21. NASDAQ is down 127 points. Ow! Oil up $1.15 a barrel. Should we even look at gas prices? They've been coming down a little bit. I wonder what's driving it, because when they were going up, the administration said they had nothing to do with it. So I would assume that going down, they don't either. $3.14 a gallon is the national average of a gallon of gasoline. I actually paid over the weekend at Costco, $3.99 a gallon for regular gasoline, regular unleaded. $3.99. I was in shock. $4.38 is the price for California as an average. $4.06 in Nevada. Josh, you paying under $4 yet? Yeah, you're under $4. Okay, Jody's at $3.52. Ooh. $2.87 for Brittany. And I'm sure that $2.77 is our tremendous underwriter, Lori. So she's at $2.77. We're still up there in the pack. I'm sure that if I looked, we're probably in California, one of the highest in the country. Hawaii, though, is still over $5 a gallon of gasoline. Moving right along. Let's see what's going on in the world today. We're going to talk a lot today about real estate. We're going to talk about the economy. Wanted to share with you. So yes, I know I have no life. So last week I spent time listening to the Chapman University Economic Forecast. I also spent time listening to our friends over at Altos Research on their housing forecast. So we got information on both of those. We're going to talk about both of them today. And we'll start out by giving away stuff. I always like to give away stuff. So if I can find my list of things to give away that's on the list. Got a couple of new ones on here. So rsrcredittips.com, rsrcredittips.com. You can go out there and get that free report on some credit tips. And on the other side of the coin, rsrcreditmistakes.com. Why am I so excited about those? We're going to be giving you we're going to have the RSR two-step. And I don't dance. No, we haven't got that one yet. but we're going to have the RSR two-step, and it's basically going to show you what we would recommend if you've got a lot of debts right now and how to protect the equity in your real estate and also have a planning process for how to minimize your housing expense. The RSR two-step basically shows you the benefits of going and refinancing right now, not worrying that interest rates are high because you're not going to keep that loan very long. When I give you the forecast from Chapman University on their economic forecast from last week, you're going to actually see some information that I share with you there that we're going to be heading into a recession. And historically, during recessions, interest rates come down. Now, we are already at the leading edge. One of Chapman's, I might let the cat out of the bag a little early. One of Chapman's leading indicators for knowing that for forecasting a recession, and it's worked historically very, very well for them, is taking a look at the 10-year Treasury and Fed funds rate. And when the 10-year Treasury yield is lower than the charge on the Fed funds rate, that tells Chapman that historically 6 months after that, there's going to be a recession. Now, that's all well and good, but what does that mean for the mortgage RSR two-step? Well, basically what the RSR two-step says is we're not that interested in interest rates today. We're more interested in interest rates later on. And if you look at what the interest rates are doing later on, well, that's the whole idea. That's the focus of where we're going. We're looking at interest rates down the road. And if we look at the interest rates down the road and not worry about today's numbers, what we're actually going to find out is they're lower. So what is the difference if you have a 7% interest rate today? And I don't know where interest rates are. I'm not quoting any rate. I'm just saying on a theoretical basis, if you had a 7% interest rate today and you pay that interest rate for 6 months, well, you're going to probably be spending less dollars out of pocket. Your debt service is going to be less than having to pay your 20, 25, 30% credit card bills because we're going to roll that all into the debt. And then we're going to wait our 6 to 12 months when historically interest rates will be cheaper than they are because of a recession. And we're going to restructure that whole thing, having taken out one of the most expensive parts of what they call loan level price adjusters. Loan level price adjusters. So what is a loan level price adjuster? These are adjustments that go into every loan that Fannie Mae, Freddie Mac, mortgage that we have that are basically saying all these different things affect the risk level of the loan. So you've got interest rate risk, you've got your credit scores, you've got the debt to income ratio, you've got what kind of a property is it? All these things go in to identify what the risk level is of the transaction. While we're looking at that risk level, we're actually going there and we're saying, okay, we got all these risks. Those are increasing the interest rates. Risk is what we look at to say, okay, the interest rates, the risk is higher. Higher the risk, higher the rate. Lower the risk, lower the rate. That's why earlier I said, go and take a look at rsrcreditmistakes.com, rsrcreditmistakes.com, and you can look at rsrcredittips.com because while this is all going on, you can actually be improving your FICO scores, which will then help us get you an even lower interest rate. We're going to talk about the Chapman forecast, the Altos forecasts and commentary. We're going to also chat a little bit about mortgage rates. Are they dropping? What does that mean for you? And 5 budgeting apps that can help you create a monthly plan and stick to it. All that and more. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
79% of all credit reports have errors that should be corrected through factual disputing. You could be saving thousands every year if your report was accurate. CreditSanitizer.com provides a free credit report audit when you furnish a specific $1 credit report. You can use this information to request corrections to your report and potentially save thousands of dollars. Get your free credit audit at CreditSanitizer.com. That's CreditSanitizer.com for a free credit report audit. CreditSanitizer.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That's my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. Let's take a look and see what the markets are doing right now. We've got the S&P 500 down 21.75. We've got the 10-year Treasury. It's up 11 basis points right now. And my 3.592. That's going to be important in a minute. Mortgage-backed securities are down 44 basis points. That means interest rates are going up. And OBMMI, they provide the most comprehensive, accurate, timely, interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. These are the rates that were locked on Friday. Doesn't tell us what the points were, doesn't tell us what the costs were, doesn't tell us any of that stuff. Just says, here's a rate, this is what it was locked at on average across 35% of all mortgage transactions. Conforming, 6.264. Jumbo, 6.356. FHA, 6.266. USDA, for those in the rural areas, generally no down payment, 6.241. And the best loan on the market for those that earned it, 6.039 is the 30-year VA loan. Why? Well, let's take a look and see why these things are happening. So last Fed meeting showed that the Fed is going to keep Fed funds rate higher for longer. San Francisco Fed President Mary Daly and Cleveland Fed President Loretta Mester spoke recently post-meeting and believe the Fed funds rate needs to get to or stay above 5% throughout 2023. Now, remember that 5% number. Are they right? Just a year and a half ago, these two were begging for more inflation and did not see it as a problem. We would not put a lot of weight in their predictions, and it will be tough to keep the Fed funds rate at such a level if inflation continues to come down and unemployment rises. S&P Global Manufacturing and Services PMI index fell from 46.4 to 44.6, which is the lowest print since April 2020. It's the sixth month in a row below 50. That means the market, the economy is in contraction, getting smaller. PMI said the numbers equate to a minus 1.5% annualized GDP reading, Q4, more signs of recession. On the labor market, manufacturers noted some layoffs due to a lack of new work, while others chose not to replace voluntary leavers. On a side note, they noted that inflationary pressures in the services sector cooled notably in December. Another good anecdote for inflation. Got a lot of reports coming out this week. We'll keep you informed on all of those. That is the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got all the programs, the products. You just need to make the call, 800-306-1990. And what's nice is if they don't have the program that's best for you, they have no problem going out and looking to see if they can find a program that meets your needs. Let's just throw that out there for you. So that's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. So chatting a little bit, I love talking to you a little bit about the mortgage numbers and that mortgage two-step that we're going to be coming out with. And one of the reasons I want to get that information to you is I just want you to realize where so many people don't think about the fact of what is the interest rate doing to our economy? What is the interest rate doing to our market? And let's take a look at some of these different numbers, and just to give you a little bit of an idea of where these numbers work out to. So I just threw into my handy dandy calculator right here. I put in an $800,000 loan, and I put in a 6.5% interest rate, and it comes back and tells me that the monthly payment is $5,056 a month. Now let's put in that same calculator a 6% interest rate. And I don't know exactly where interest rates are. And I'm not giving any kind of APRs on this because all I'm trying to do is educate you on what interest rates do over time for people. So let's put in that same $800,000 loan, and let's put in a 6% interest rate and see what our payment comes out to on that one. So the payment comes out on that one, on the first one, comes out to $5,056. The second at 6%, same 800,000, comes out at $4,796. And just for fun, let's put in there a 5.5% rate. And I'm just throwing numbers in there. They don't really mean anything other than just a little bit of an example for you. At a 5.5% rate, we're now looking at $45.42. And I'm doing all this on the fly. So I'm not prepared to go through and give you the specifics or the exacts on all these things. But what I want you to understand is take a look at going from 6.5 to 5.5. Yes, I understand that we all want to save as much money as we can, but planning, and I'll share this with you. I've used this terminology many, many times. Strategy beats rate always. Strategy beats rate always. What does that mean? Well, understanding where these numbers are coming from and what you're trying to accomplish. So I'm just looked at it real quick. I'm doing some of these things on the fly. And I look at that 6.5% rate. And then I look at the 6% rate. And I've got one more number I want to plug into this whole mess. So the difference between a 0.5% of interest rate is a little over $250 a month. That's what we're saving. Now I know $250 a month is a lot of money, but here's the issue. So if you're paying 25% or 30% on your credit cards, and you're doing that, and if you make a minimum payment, you'll get them paid off in about 300 years, give or take. Here's the idea. Roll it all into a new mortgage if you've got the equity on your real estate, on your property. Now, I'm going to say something that nobody's going to really tell you. Ask your lender or your home loan strategist to call us 800-306-1990. We'll put together a strategy for you. Say, what would it cost me? And I know it's going to cost higher interest to get a no-cost loan. Now, there's really no such thing as a no-cost loan. What a no-cost loan means is that the costs are built into the interest rate. But let's just say that right now the market's at 6%. I don't know whether it is or isn't. And let's just say that if we go with a 6.5%, you can get a no-cost loan. Okay, so that no-cost loan is costing you an extra $260 a month. That's about $3,100 for a year. Okay, so you're not going to pay it. What's going to end up happening is you're going to look at restructuring if the interest rates come down as we forecast. There's no guarantees, but history says the interest rates will come down. And let's just say that we go and we get that 5.5% interest rate. Well, you're going to save $510 a month because you're going from 6.5 to 5.5. So you're going to save $510 a month more than where you're already saving by doing the restructuring. Think about that. So now you're looking at about 6 months to pay for the new loan. We don't want to build that in the RSR two-step. We don't build that in because this is the loan we're going to keep for a longer period of time. And I don't know what longer means. It could be 2 years, 3 years, 10 years. I don't know, because as a home loan strategist and a certified liability advisor, what our team does is consistently monitor your liabilities. Your mortgage is one of your biggest liabilities. So if that 5.5 that you get becomes, okay, well, the market goes down to 4.5, well, our team's going to call you and say, hey, you know something? You want to save another $510 a month? Got about a 6-month break even, give or take. Well, of course you will. And now we've just lowered you down to a 4.5% loan. And if it goes down again, you do it again. Now, I know you're going to say, Ron, this sounds self-fulfilling. You like doing these things because it's going to help you and you're going to do more loans. Well, yeah, you're right. We do more loans that way. But the bottom line is it's in your best interest. We don't need to do loans that's in our best interest. We do a lot of loans. But the idea is, how do we do more loans that help you? And if you don't have somebody watching these things for you, do you know this stuff on your own? Do you know what your blended household interest rate is? Most people don't. Well, how do you even calculate it? Well, we've got a special calculator that will put that in there. So it's just a matter of getting that and putting all your liabilities in, and we figure out what is your blended household interest rate. May come out that you may not even know it and say, well, Ron, I've got a 3% mortgage. And I say, yeah, very good, but you've got a 9% blended household interest rate. Who cares about a 3% mortgage when you're paying all this extra money? If you don't understand those things, let's set up a strategy call. 800-306-1990. 800-306-1990. One of the team is more than happy to help you. Need to get some baseline information to get started, and then we'll put it all together for you. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, mortgage rates are dropping. What does that mean for you? And 5 budgeting apps that can help you create a monthly plan and stick to it. All that and more. You can reach me anytime. Our off-air number, it's 800-306-1990. 800-306-1990 or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Is your budget getting blown up with high prices of gas and increased costs for other household needs? This is Ron Siegel, host of the daily Home and Finance radio program. Did you know if you have a low interest rate mortgage along with auto debt, credit card debt, or student loans, your family could potentially save $500 or more per month by restructuring these debts? If you'd like a free Borrow Smart analysis with our team, let's book an appointment to see how we might be able to relieve some stress. Schedule your appointment at rsrbsa.com. That's rsrbsa.com for your free Borrow Smart analysis. rsrbsa.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990. 800-306-1990. Our real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. Mortgage rates are dropping. What does that mean for you? Mortgage rates have been a hot topic in the housing market the past 12 months. Compared to the beginning of 2022, rates have risen dramatically. Now they're dropping, and that has to do with everything happening in the economy. Just to give you an idea of what the rates are doing and where they're dropping and what they're coming to, as of last Thursday, Freddie Mac reported 6.31 was their mortgage market survey, 6.31. Now, as of the 1st of January, 3.22 was what the Freddie Mac rate was on the 6th of January, 2021, 3.22. And I'm looking back. I've got the first reading in January for each of the last 6 years. 3.22 in 22, 2.65 in 21, 3.72 in 20, 4.51 in 19, 3.95 in 18, and 4.20 in 17. So in 22, it was 3.22, and as of right now, 6.31. They used to tell us how many points you had to pay to get that, but they don't tell us that anymore. But the bottom line is the rates are increasing. Now they've come back down, and I should look at that number for you because I'll tell you that one as well. Right around the middle of November is when they peaked out at 7.08 on the 10th of November, and now they're at 6.31. So even though they're up a little bit today, we'll see what happens the rest of the week. Nadia Evangelos, senior economist and director of forecasting at the National Association of Realtors, explains it well by saying, quote, mortgage rates have dropped even further this week as two main factors affecting today's mortgage market became more favorable. Inflation continued to ease while the Federal Reserve switched to a smaller interest rate hike. As a result, according to Freddie Mac, the 30-year fixed mortgage fell to 6.31 from 6.33 the previous week, unquote. So, what does that mean for your homeownership plans? As mortgage rates fluctuate, they impact your purchasing power by influencing the cost of buying a home. Even a small dip can help boost your purchasing power. Here's how it works. The median priced home, according to the National Association of Realtors, is $379,100. That is a national number. Again, out here in Southern California, it is higher in most areas. Let's assume you want to buy a $400,000 home. If you're trying to shop at that price point and keep your monthly payment about $2,500 to $2,600 or below, here's how your purchasing power can change as mortgage rates move up or down. If you're watching us on RonSiegelRadio.tv or the ABC News and Talk AM 1490 video feed, you're seeing a chart. And it shows how the rates, how your buying power is going to change. Now, we've talked about this before. We can help you change that buying power by using your offer strategically. So if we watch this chart, we can see that at keeping that $2,600 a month payment. So is that what we said? $2,600, $2,500 to $2,600. Okay, let's take a look at it. At $400,000, $2,594 is a 6.75 interest rate. Now, if you want to keep that same $2,594 and interest goes up to 7%, now you're looking at $380,000 purchase power. But if interest goes down to 6.5%, your purchasing power goes to $420,000. If we go to 6%, you got $2,638, get you a $440,000 house. That's extra 10% on the purchasing power. Again, you may need to double these numbers here in California. This goes to show even a small quarter point change in mortgage rates can impact your monthly mortgage payment. That's why it's important to work with a trusted real estate professional who follows what the experts are projecting for mortgage rates for the days and months and year ahead. Bottom line, mortgage rates are likely to fluctuate depending upon what happens with inflation moving forward, but they have dropped slightly in recent weeks. If a 7% rate was too high for you, it may be time to contact a lender to see if the current rate is more in line with your goal for a monthly housing expense. Remember, we talked about this before, and I don't remember if Josh, I don't know if we did a sheet or demo on this. Sure we did. rsrpaymentassist.com, rsrpaymentassist.com. We actually showed you how interest rates will fluctuate and how we can take and say, okay, you're looking at a $700,000, $800,000, $1 million, $500,000, whatever the number is. You're looking at all these different numbers for a purchase price, and you're saying, okay, well, the market is slowing, so I'm going to make an offer to discount that price. Well, I'm going to share with you, because no one else will, that...
You know better than that.
Yeah, if you've been listening to Ron Siegel Radio, you know the answer is not discounting the price. It's asking the seller, hey, Mr. Seller, Mrs. Seller, would you mind taking, you've got an $800,000 property, and how about taking, I was going to offer you $750,000, but how about just if I offer you 800, but give me $50,000 toward lowering the interest rate, so it helps me with my payment, that'll bring that interest rate down. Now, what that'll frequently do, and I don't know the exact numbers, but in many, many instances, we've seen where that'll bring the interest rate down 1.5 points. Now, let's think about that. Let's go back to the example we used in the last segment. And if we started out at, say, 6%, and we go to 4.5% on the interest rate, and we're looking at, let me just get this number in here real quick because I just talked to you. So we're looking at $4,053. So we go from 6% to 4.5% is $4,053. That's about a $740 a month savings. Think about $740 a month. Now, why does that matter? Well, obviously, for your budget, it helps. But the other part that's really important about it is it helps you qualify. When it's done the right way, it'll help you qualify for that more expensive property. Now, you could wait, but if you wait, what happens? Well, interest rates come down, which brings more buyers into the marketplace. More buyers into the marketplace brings you back to where you were a year ago, putting in 10 offers and getting them all rejected. Is that what you want? If you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, have them give me a call at 800-306-1990, 800-306-1990. Let's put together a strategy for them to get that new home. That's the Real-Time Real Estate segment brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. So let's chat a little bit, maybe a lot of bit. We're going to talk about Chapman University, and Chapman came out with their economic forecast last week. And as you know, I did go to Chapman College. It was before it was a university. But we're going to look at some of the charts that Chapman shared in their forecast. And again, I love looking at Chapman's numbers because not only is their forecast is at my alma mater, but if you look at the accuracy rankings, Chapman's always right near the top. And their accuracy rankings forecast of real GDP 2004 to 2021, Chapman was number 1. Morgan Stanley was number 2. Northern Trust was number 3. So gives us credibility for using Chapman. UCLA was number 8 out of 18. If we look at the accuracy ranking for real GDP, unemployment, inflation, housing starts, again, Chapman number 1, Northern Trust was number 2, Morgan Stanley number 3, UCLA was number 14 out of 17 on this chart. So let's take a look at some of these different numbers and see what makes sense. Now, Chapman in this forecast, they compared a lot of things to 1974, I believe it was, the recession of 74. And what they looked at was the 10-year T-bond less the Fed funds rate. So they looked at that going all the way back to 1965, but they focused on the 74 recession just to use it as an easy example. But going all the way back to 1965, whenever the 10-year Treasury is less than the Fed funds rate, Now, should I remind you of what I told you a little bit earlier? So let's take a look and we'll see where the 10-year Treasury, we know right now is at, if I can get that chart back on my screen, 10-year Treasury is at 3.596. I wonder if I've got a chart that I can grab real quick on comparing these. I'm not seeing it real quick, so otherwise I would give it to you right now. But what I want you to understand, let me look and see if I can figure out the Fed funds rate. They just changed the Fed funds rate. So I think it's 4 to 4.25 is where they're sitting right now. 4.25 to 4.5. So let's use the lower number, 4.25. And we're going to compare that to the 10-year Treasury at 3.59. Remember, 10-year Treasury being lower than the Fed funds rate. So we're obviously, what's that? For about 65 basis points lower. What does that tell us according to Chapman University? Well, going back to 1965, that tells us that within 6 months, we will be in a recession, according to Chapman's historical numbers. So we're looking at 6 months is where we're going to be right there. 10-year bond less the Fed funds rate. So the big issue there, we're already seeing some of this. The housing starts, that's a big forecaster. We're starting to see that some in the residential investment, housing starts has already started to drop. So one of the things about that that's good, and a lot of people will say, well, Ron, how is a drop in housing starts? How can that be good? Well, the reason it's good is that means there's going to be less supply. So remember, supply and demand drives everything. There's not a catalyst for somebody that has a 3% mortgage to sell their house unless there's some life event. The life event means somebody passes on, somebody gets divorced, somebody has a relocation. Those are life events that sometimes happen. So those things force people to sell. That's the reason somebody would sell a 3% mortgage to go and buy something else, other than the RSR two-step that we spoke about earlier. So the bottom line here is not going to get a lot of new houses coming on the market, and there's got to be a catalyst for somebody to sell. So that means supply is going to be low. So supply being low, now we have to look at the demand side. Well, those house sellers that don't have to sell, they're not going to be a buyer. So that's not going to help our demand. But wait a second. Young people are getting older. They're starting their own households. That's called household formation. So those are going to be buyers. That's going to help demand. We're going to have people retiring. That's going to help demand. We're going to have relocations. I told you that people are leaving California. Chapman will put that in their forecast also, that people are leaving California. That helps demand. So we've got all these catalysts for demand and not a lot of new supply. That tells us we've got some strength right there on the market there's strength in the market for holding prices firm. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, 5 budgeting apps. I might even come up with a 6th for you that can help you create a monthly plan and stick to it. We'll get into that and more of the Chapman Forecast. When we come back, you can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Your Credit Matters segment today being brought to you by CreditSanitizer.com. You have a credit report. It is wrong. What are you doing about it? Credit Sanitizer, they've got these solutions for you. You just need to make that call, 800-306-1990, 800-306-1990. Let's take a look. Whoops, I just lost the report. 5 budgeting tips that can help you create a monthly plan and stick to it. We might even give you a 6th because I believe, Josh, you might know this better than me, but I believe that RSR Home Scout now has a budgeting app on there as well. So I think that that's all part of RSRHomescout.com, homescout.com. But let's take a look and see what the report says. Let's face it, you've got a lot going on, and budgeting may not be at the top of your to-do list. Keeping up with a budget requires time, dedication, and staying on track. With smartphone budgeting apps, money management is easier than ever. The best budget apps connect to your bank accounts and other financial accounts to track your spending in real time. No need for manual calculations, balancing checkbooks, and filing away papers. Using a budgeting tool, especially one you like, could make staying on budget so much easier. The trick is finding the tool that works best for you. Let's take a look at 5 apps that could help you take the stress out of budgeting. Mint. Mint is one of the most popular apps for creating a budget, and it's free. It'll automatically categorize your transactions, pay your bills, and send alerts to keep you organized. Mint then uses that information to estimate your credit score, visualize your spending, help you set limits on expenditures, and offer advice based on your spending habits. Who's it most useful for? Somebody who already knows how to budget but wants a fresh start. You need a budget. If you're looking to get more engaged with your money, you need a budget. Is beloved by its users. That's another one of the apps. It's based on a zero-sum system that requires you to allocate every dollar of your income, prompting you to gain total control of your money. Fair warning, this budgeting app requires a bit more discipline than the others, so be ready to roll up your sleeves. Users pay a yearly fee, but a free trial is available for beginners. Who's it most useful for? Anyone, whether experienced or budgeting, or a novice who prefers to have more manual control of their budget. Another one, you need a budget. If you're looking to get more engaged with your money, you need a budget. It's beloved by its users. Users pay a yearly fee, but a free trial is available for beginners. You need a budget. Again, it's a zero-sum system that requires you to allocate every dollar of income, but fair warning, more discipline. Envelopes. The letter M, V-E-L-O-P-E-S. Before there were digital budgeting apps, there was the envelope system. Envelopes uses that envelope-based method as a base for their system of categorized cash envelopes. Focused on flexibility, envelopes works for users who have a lot of expenses to track. You can also set rules and restrictions on your habits to help you stay on course. Who it's most useful for? Freelancers and contractors who don't have consistent income month to month, and or frivolous spenders who want to curb their habits. Next one, Home Budget. Designed with families in mind, Home Budget boasts capability across multiple devices and accounts and allows you to control as much or as little spending as you wish, known for its seamless data reporting. This app could help you generate trend graphs and infographics easily. You get the most out of Home Budget when you take advantage of its full capabilities, so don't be afraid to try out every feature. Who it's most useful for is families that want to have more than one person manage the household expenses, and or budgeters who want to visualize data. Next one, Pocket Guard. It keeps things simple for people who are looking to make better financial decisions. Signing up for the free version lets you connect your checking and savings account, credit card account, installment loans, and other accounts as you track your bills. The app monitors your cash flow and tells you whether you can meet your savings goal after paying for food, utilities, and other essential items. You can also track finances manually. With the paid version, you can export spreadsheets and create a personalized plan to manage and pay off your debt. Who is this most useful for? Anyone experienced with budgeting or not, looking for a simple, easy-to-use tool that helps them take control of their finances and eliminate overspending. There's a budgeting app for everyone. When you're choosing which app is best for you, be sure to consider the customizability and flexibility of each app and compare those features to your own needs. Whether you've never budgeted before or you're an experienced personal finance manager, there's an app out there to fit your needs and your goals. Managing your budget can be scary. It can take a lot of work, but it's a necessary task to get you where you want to go. If you want help with any of these things, give me a call at 800-306-1990, 800-306-1990. Remember, if you have any friends, family, or coworkers looking to help their credit scores, we've got the tools for you. Remember, we gave you 2 of them earlier in the broadcast today. We've got rsrcreditmistakes.com, rsrcreditmistakes.com. We've got rsrcredittips.com and creditsanitizer.com. You can go to that one, creditsanitizer.com, And that one will actually get you a complimentary credit audit. Now, you do have to buy the $1 credit report. It's a very specific credit report. But when you go to creditsanitizer.com, you can fill out a short little form there, and you'll be able to get all of that directly from creditsanitizer.com. They'll give you the form to the name of the service that you need to get the credit report from. Your Credit Matters segment brought to you by creditsanitizer.com. You have a credit report and it is wrong. What are you doing about it? So let's continue our conversation on the forecasting that we've been talking about. Great information there. So Chapman University, we got there some information from them. Key there is the 10-year T-bond being less than the Fed funds rate. So we're already in that point right now. So that tells us 6 months we'll be in recession. Got to remember, it takes 6 months for the Federal Bureau of Economic Research to tell us that we were in a recession. So, you're already there. Residential investment and consumer spending in 1974 was below water, and we're watching and forecasting third quarter of 2020, right now, the fourth quarter that we're in right now, and the first quarter of 23 and through the third quarter of 23. We're looking at being underwater, as according to Chapman's forecast. Real GDP, this is the one that is going to really hurt some people, many people. Real GDP. So remember, the definition of a recession historically has been 2 negative quarters of GDP. Well, we're looking at, we already had 2 this year. They didn't want to call it a recession because that's not convenient. But we're looking at going into 2023, and if Chapman's forecast is correct, by the second quarter of 2023, our real GDP should be down about 6%. Now, that's a steep number, but that means we're going to be in recession basically from the beginning of 23 all the way till about the end of 23. We may be coming out of it right near the end of the year. And we're just watching that because that's just personalized savings is dropping. Where every number that we can find, disposable income is flat. The personal saving rate is down in every manner that we look at. Credit card spending is up. People are living on their credit cards. These are all numbers coming out of the Chapman forecast. Now, I did hear a comment this morning from one person on one of the business channels, and their basic comment was, hey, watch what's going on. A lot of CEOs are saying right now, we're not going to really look at getting rid of employees. If somebody leaves, we're not going to replace them. But we're not looking at getting rid of firing people because it's too hard to get them back and retrained. So that's going to be a hit on the corporate income side of what's going on. So be aware of that. Now, the next one that I did look at is Altos Research, and they did their report. They do a report every month. They give us updates on the housing industry. Now, you know that you can get a copy of your zip code, what's going on in the world for yourself. Go to rsranalist.com, I think it is. rsranalist.com. Let me just double check that. rsranalist.com. So what is that going to do for you? Well, I guess I've got it backwards. Josh, what's the right thing on that one? rsrlistana.com. rsrlistana.com. What happens there? You're going to go in there and it's going to ask you to put in your name and email address, and it's going to give you a report for Anaheim 92807 or 92808. I know you don't live there. Maybe you do, but for the most part, you probably don't live there. But once you get that first report, you can put in any zip code in the United States and see what's happening with real estate prices in that area. So go to rsrlistana.com, rsrlistana.com, and get the report and find out what's going on before you even think about doing a price reduction on your home. Make sure you're checking that out. And as always, I ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh who's engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990 or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.